You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Well, folks, with the retail investing surge contributing to back-to-back years of record options volume, let's explore the trend with a discussion on the key topics that are influencing the retail community. Help me welcome our moderator, the Vice President and Chief Market Strategist at tastytrade, J.J. Kinahan, and his panelist, Greg Ferrari with Nasdaq, Ovidio Montemayor from TD Ameritrade, and Greg Stevens with Fidelity Investments.
Thanks to everyone for being here. I know particularly for the East Coast guys, you're like, it's actually 5:15 back home. Happy hour started, so let's wrap it up quick. So we hope to keep it at least interesting if you stuck around for this. So anyway, we're talking about the industry. We'll break it down into three different levels in terms of questions. We will start with kind of how we got here, where we're at, and then probably the most interesting part, where we're going. One thing that all four of us, I think, agree on, it's a lot more fun to hear from everybody else than it is just to hear from us. If you have questions at any time, we won't wait till the end. Just raise your hand. We, may as well have a little bit of fun. If people have questions in between, whatever it is, we're happy to take them at any time and on anything we talk about. So, is a lot of the panels that you've all attended over the last little bit have talked about the last 2 years, but I think we get a great, unique perspective from I'll have to say Ferrari because there's two Gregs. So Mr. Ferrari and Ovi and Greg in terms of their particular spots in the industry overall. So guys, let's talk about, first of all, I'll start with you, Greg. Greg Ferrari. This is going to be hard.
Yeah.
In terms of the last 2 years, and I think the untold story of the last 2 years primarily, we know all about the clients, and we'll talk to that with your two other panelists, but how the exchange had to react, and I think one of the things that all exchanges deserve a pat on the back, as does the whole industry, is how well we performed in terms of, so talk about what that meant for you guys as an exchange.
So thanks, JJ, and it's a pleasure to be here. The last 2 years really was a culmination of strategic capital allocation towards the options business, looking really at the capacity, the resiliency, the infrastructure that enables what we believe to be an advertisement for a quality quote-driven market, which enables retail to have confidence to, essentially execute sort of flawlessly and seamlessly. That does not happen easily. So we have, multi-year planning sessions, but when you come down to the pandemic came sort of at a moment's notice, trading floors closed, you have to make some quick decisions how to not disrupt workflow for the institutional community while retail continue to scale over time. What we saw was an opportunity to make, dedicated investment quickly, just like our peer group from other exchange operators, that enabled for the industry to operate flawlessly without any disruption. And really what it came down to was we did it timely, we did it swiftly, and we had no disruption of service for the market participants.
And I guess a quick follow-up on that, Greg, is, when I think about the amount of regulations as an exchange you have to deal with, how did that part of it go in terms of working with the different regulators, because it was such a change to the model so quickly?
I'll take that in two parts. One, in a working from home environment, in a supervisory function, how did the regulators think about, our role as an SRO in terms of oversight and regulation of our market participants? One, we operate a trading floor, and then you have those that are, working from home and essentially enabling through systems and workflow, and how do they govern and oversight of that activity? So that's one element. Another one is just really, how do they think about the sustainability of the market and our role in terms of, shepherding that through without any disruption? So we were having weekly calls with the regulators, making sure from a net capital perspective, from a capacity perspective, that we essentially had the belts and suspenders to be able to withstand the volume that was coming in the market.
Okay, thanks, Greg. Ovi, to you, I know as a old operations guy, so to speak, that the operations part of the business means a lot to you, and we were working together at the time, and I think one of the most incredible things that happened while we were there was the amount of applications that came in, particularly over one weekend. It was absolutely mind-boggling. So just talk about how the firm dealt with that kind of quick scale-up from that point of view.
Yeah, no, thank you, JJ. And I think, a lot of people seem to think that it's a quick scale-up, and I get this question a lot. And it's really not a quick scale-up. It's a long-term, it's strategic planning. It's a lot of strategic investment that happened years before that, right? So there's a lot of work that goes into it, right, from technology teams, right, compliance, legal, obviously operations, and, all of our trading operations teams to make all of that really, come to life and to provide the type of service that they're used to day in and day out. So a very consistent experience is critical. But when you see hockey stick type growth, like you see behind us, having your systems up, right, making those investments just to ensure that you're up and running and you're able to provide that consistent experience. And all of that really leads back to confidence. And Greg mentioned too, right? Confidence in your platform, confidence in your firm, and confidence in the options market as a whole as another, right, tool, right, in their investing, journey. So it's a lot of work. But I would also, maybe like to take a moment just to thank so many other people that make this hockey stick possible. And I would start by, obviously thanking everyone at the OCC, at OIC, because education is critical to allowing this to happen. But even back at our own firms, right, whether it's your compliance department, your legal department, your operations group, your P&S groups, there's so many people that work so hard, right, day in and day out to make this possible. It was truly, just impressive, to see it all come together and still provide that very high level of consistent, service for that many new clients.
I think Ovi's going to want a copy of the transcript because the first person he thanked from his own firm was compliance. So anyway, and Greg, from your point of view, Ovi talked about a bit maybe of the operations, a lot of people to thank, but if you could talk to it from a customer service end, because I thought that was the other end that was probably the most challenging for most firms because, let's face it, phone queues absolutely blew up. Yep. You guys hired, I believe it was 30,000, please correct me if I'm wrong, people. And so, it's just incredible what went on in our industry in terms of the amount of scale up from the just plain customer service end.
Yeah, I have to reiterate what Obi was saying, though. A lot of planning went into being able to support reliability, scalability, and everything to take on this additional volume. And to your point, it was a little over 20,000 that we hired in the last 2 years. However, we're going to get to that 30,000 number because we announced just recently we're going to hire another 12,000 people by the end of Q3. So if any of you have college graduates out there, you know where to send them to. We got more than a few openings. But it does go to talking about the scale. Customer service and our technology partners have to be given a big pat on the back and probably an even bigger bonus. They stood up to the test. We worked from home. We pivoted real quickly. But it took, a lot of planning, a lot of coordination, with that. Just to give you an idea of the scale that we're talking about. JJ mentioned, a lot of applications coming in. And I think this speaks to, COVID a little bit and the pull forward I think we had with some newer investors. In 2021, we added 3.8 million new accounts under the age of 35, another 640,000 in just Q1. And that comes along with all the options applications and everything and digitize. Part of the reason why we're hiring customer service and technology reps is to make sure that we can digitize, we can support, this huge, influx of new customers, and it takes a lot of work to do so. But that was incredible, and I think JJ, we seen something that might have taken us 5, maybe even 10 years to get these participants in.
Yeah, it's funny. I think many of us saw this. Think about this conference 5-6 years ago. One of the topics we were talking about was how do we get young people interested in investing? And as an industry, we spend so much time talking about this, and I don't think any of us expected them all to come in a 2-week period. But overall, I think that, Ovi alluded to it, and both Gregs alluded to it. A lot of this had to do with the planning and the fact that we really did spend a lot of time thinking about this, planning for this, so that people could be successful when they came here. And so, that's kind of the past. Now I want to talk about where we're at, because I think we're all off those amazing volumes we saw. We're still well above 2019 volumes, and Henry, as always, did an unbelievable job up here presenting some of the things that are going on in the industry. But, Ovi, I'll start with you on this one. As you talk to clients and your teams are hearing from clients, how are they feeling? There's so much going on right now between a geopolitical situation, inflation, the meme stocks, aren't what they once were, if you will. And I think that many people just are having trouble knowing where to turn. So what are you guys talking to your clients about right now, particularly from the option side of the business? If you want to talk general and then a bit on the option side of the business.
Well, generally, what we're seeing, you mentioned there's a lot of new clients, right, 35 and under. We're seeing the same. A lot of new entrants to this market. And with those new entrants have different sets of requirements, different needs than historically maybe other clients or other segments have needed. Specifically, that's education, right? They're starving for knowledge. We could talk about, our volumes are up 200-300% in certain cases on certain days, right? But the demand for education is up 8-fold, right? It's even, double that. It's tremendous, right? We try to meet them where they want to be, right? So it's videos, it's online, it's on YouTube, it's podcasts, it's live events, right? It's newsletters, there's, constant communication, there's coaching. We really just need to be able to, as an industry, continue to, fill that gap and ensure that they're getting the, the needs, their wants and their needs met, right? That in our perspective, from our perspective is absolutely critical. And like, we've attracted the clients, they're here, but we need to keep them here and keep them safe, right? So a lot of the education is really, to ensure that they're trading, in a safe way, right? So, if you were to, jump on a course, and I provide everybody some links here at the end if anybody wants to jump on, but, what the themes there are risk-defined strategies, right? So there seems to be a misconception you see on random slides and saying, well, retail's the one lot, retail's all the singles, even recent research papers where they seem to only focus on, right, the marketable flow that goes into the auction mechanisms. And I guess I'd like to maybe dispel a little bit of that, right? Retail clients are surprisingly more sophisticated than a lot of, individuals are maybe currently giving them credit for. And, another thing that we've noticed that over time, now we're talking like age of client, specifically for us, age of clients, the longer they've been there and measured in years, right, the more complex type strategies that are being deployed. So I think that's being discounted, in a big way. But, the way that we really view it is they're graduating from level to level, right? And the other misconception I think that's out there is, you mentioned account openings and the approval process, that everyone comes in and they get whatever level they ask for or request, and that's far from the truth, right? A very small percentage of total clients have full option approval, and this is all designed to keep clients safe. We have a large incentive to keep them safe, to keep them here, keep them investing in their future, and allowing them or educating them on different ways where they could reduce risk or enter into trades in a very risk-defined manner, which are some of the things that we do to just ensure that we're not only taking the new volume and everything that comes with that, but being a responsible agent in the market to ensure that long term, right, these clients are going to be in this market and investing for their future.
To follow on Ovi's point, I think we have an opportunity as an industry to write our narrative. We did it well. Essentially the ascension of education with liquidity and trust aligned with innovation. We really have an opportunity to tell our story, that we're essentially a product that's really geared around risk mitigation, not around sort of cowboy-type sort of risk-deploying, capital out there in the market, and really goes back to the work that all three of you do, and amongst myriad of others that really enable responsible investing, not trading, and how the options market are geared towards sort of the right behavior in the market. So I really think we have an opportunity to really tell our story.
Yeah, I'd like to take up a little bit on that one myself, and Ovi mentioned that paper, and I know many of you probably saw that last week. So all I would say is if you read that, please look at the fact that they didn't count any options within 10 days expiration. And Mr. Ferrari, I know from a meeting today, can supply us with some information as to how much of the volume is within that. And the second thing is they also had a premise that no options are used for hedging whatsoever. So if people lost, I think sometimes people forget when they look at the options product. There are times, I never want to say I want to lose money ever on anything, but I don't mind so much if I lose money on my hedge.
Right.
And so I think that's often discounted when I see papers on the options industry. So that's, in my opinion, the major flaw, or major two flaws, is the time frame and the throwing out hedging not even existing in that. And Greg, I don't know if you want to go back to what we discussed today in the meeting in terms of some of the time frames of when options are actually being traded right now.
I mean, Henry pointed out in his slides, it is a tremendous focus on short-term, really protection in the market, maybe some yield-enhancing strategies that are short-term in nature. But when we look at Monday and Wednesday activity in SPY, QQQ, and IWM, just looking at SPY as a percentage of volume in the Mondays and Wednesdays versus overall, it's now 40% of the volume. And that, has climbed literally, 500 basis points every year for the last 5 years. And so to me, that's around risk mitigation. That's around, sort of portfolio management and having really your portfolio concentrated in, call it 10, 20 names that are really driving the market. And how do I, to JJ's point, utilize sort of, benchmark indices, with liquid ETFs in terms of a risk mitigation product that really can help, position you accordingly.
All right, Mr. Stevens, back over to you, because I want to be fair. We can't say that there hasn't been an uptick, particularly in individual names, over the last couple of years, and people, doing more speculative type trades. So, again, to give both sides of that, we know that's grown. But if you could just talk about how has your product mix changed towards options, maybe even from 2 years to 6 months ago, and has it changed at all over the last 6 months as we've seen some of the volumes come off of it?
Yeah, I mean, we've definitely seen a growth in the interest and the product mix. I mean, more options trades. I mean, just overall, I mean, the rising tide lifts all ships, right? But we have seen, I mean, and I think that, a lot of that has to do with the influx of new customers, the education, the support, that we've had around it. And, the interesting thing, too, is, I mean, as we start to, pull back a little bit, equity volumes, are pulling back just a tad, the percent of option trades is going up, as that overall flow goes. And I think that, speaks a lot to, what customers, are doing with options, how they're seeing this as an investable class, speculative, as well. But, in, times like now where we're very volatile, they're taking the opportunity, I think, to go back to hedging, to doing different trades. But we're definitely, I mean, we've doubled the number of trades in the last 2-3 years from pre-pandemic, and I mean the account growth is a big part of that. And so I think that to go back to the education piece, I think we're going to hear about that a lot at this conference, and it can't be understated. If you teach them to fish, I mean they're going to continue to come back and to realize the value of it. And options, I think Ovi, you mentioned they've got an insatiable desire, these under 35 to learn, and I mean that's where we're really at, JJ. I think that it's going to continuing to see the benefits that we sowed a long time ago. Back in the late 90s, in the early 2000s, the increase in education, those volumes are continuing to build.
If I could just add.
Yeah, I was going to ask you that similar question, so please.
Yeah, like on that product mix, some other things that, in addition to, the points that he made there were, we're obviously seeing clients trading smaller size. I think we saw that in some of the slides in the earlier presentation. They are trading smaller. When we speak to our clients, right, they think there's tremendous value in many ways. Reducing those commissions, right, has allowed clients to trade in a different way where they could scale in, scale out, which naturally leads to smaller size, right? Even if you were going to put on let's say a medium, kind of type trade, I mean, why not scale in and scale out if it doesn't cost you any more or anything, right? I mean, it's the same. So I think there's a natural incentive. There was also another interesting comment on the SIBO slide, right, that the average is hovering around 7. And that's something that we watch daily, right? And we thought, well, how far does it go? And does it, just continue to crater to, 2, 1? I mean, where does it stop? And, what we're finding is that clients are different. There's different segments of clients. And just like I talked about all of the education, and over years, their sophistication of these clients continues to go up. So another really interesting point that I've seen is that while you have, a lot of industry news and events that are happening, and equity volumes absolutely spike, right? And everyone sees it, you get an alert, and, everyone's watching that. But what we're seeing that it's more equity driven, right? Those spikes in volume are more of an equity phenomenon, where what we're seeing is that sophistication of those clients in trading in a risk-defined manner allows them to trade in any market condition. So what we're seeing is that the volumes and options continue to rise, and all of a sudden we see this hockey stick. And I think the hockey stick is partly due to a slower curve. I think of it more of as a rubber band, right? So all the clients come in, they don't all start trading like crazy. They come in, then they realize, I need to learn. I need to take a step back. So then what we're seeing is that rubber band, right? So, they come in, they learn, and that continues to kind of snap, right, and project forward, like, projecting future volumes. We've also seen that in examples where we had purchased maybe another firm, specifically maybe out of St. Louis, where we were able to provide them with a lot more tools, a new platform, new tools, new education. And, our hypothesis was right, that if they say if you build it, they will come, right? We already had it in that case. But the more that we coupled that, award-winning kind of platform that's easy to trade with a lot of risk tools, within it, coupled with the education, gave them more confidence to trade and invest in their own futures, right? So that's where I think we're seeing that spike, right? That rubber band effect, partly due to the education and the delay in the sophistication as they kind of graduate from level to level. Those volumes are also more consistent across the board.
I was going to say, it's okay to be boring. Like, defense wins championships, so you want to see continued prolific growth within our industry from sophisticated use over time and consistency. And so just thinking about the NFL, all right, they're making essentially the game safer. They make it fan-friendly, but, how do you essentially perform? It's strategy, and it's around execution, typically around defense, right? And so our product is really geared around that, while creating a great experience throughout its sort of life cycle, if you will.
So I'm proud we made it halfway through and we haven't mentioned the word crypto yet. But anyway, but I think crypto has maybe helped in one way. And Ferrari, I'll start with you. It always seemed to me when I talked about the word options, it was always, those risky things.
Yep.
And I'm not really hearing it as much anymore from individuals. Maybe some of the regulatory environment seems to think they're perhaps riskier than they are. But I'm just kind of wondering, are you guys, it can go to anybody, I'll start with you though, Greg, in terms of, I think the general public, that perception is off. I don't know if you guys feel that way.
That's our sense. And, we work with a lot of ETF issuers in terms of product creation that have option wrappers embedded in there. Henry mentioned the defined outcome products as an enabler for growth. Really, it's individuals or advisors or individuals trusting advisors really looking at product creation and innovation, enabling participation in the market in a defined, structured way. And so, yes, there are inherent risks with any product like the one we operate within. And so the education and the product creation, along with workflow and innovation, typically yields a positive outcome and a positive outlook for users of our product. And I'll another shout out, if you will, to the liquidity providers. They are essentially in there all day, every day, fighting for your orders, servicing you quite well, and really competing in a manner that shows up each and every day on the screens. And obviously, that's a huge part of the success to why we're growing the way we are.
Yeah, I agree with that. I was on a panel a few weeks ago, and I said that they have to play in the World Series every single day,
right?
Because the competition they go under is actually pretty incredible. But Ovi or Greg, anything you guys wanted to add on either point there?
Yeah, I mean, I think that you don't get the sense anymore that most of our retail customers or in general feel that it's risky. The thing that I get from them, and it's feedback that we get from our webinars, our classes, that we do, is still that uncertainty of how to get started, because there's so many choices, so many different ways to take advantage of a forecast. And what we really focus on in those sessions is trying to dispel that uncertainty. It's not the risk. It's not that this is speculation or gambling. It's what to choose and how to choose it. And so providing a process, I think, and we've all done it over the years, has really changed that focus.
And one of the things to help people get started, and kudos to Mr. Ferrari and really all the exchanges, is the delisting of some strikes. I think that was such a problem, and I think Henry alluded to it up here that used to be a panel every year. So, very nice that the exchanges have helped get rid of some of the strikes that were worthless, so that people who are making markets don't have to waste their time and energy on things that are never going to trade. But with that, and talking about new products as we look forward, Greg, there's some going on there. You guys have talked about, you've done a great job in terms of eliminating some things, but as always, we want to head forward with new products. You have some things you're talking about. Your competitors have a few things that they're trying to do to perhaps take more advantage of the retail trader. So I don't know if you want to talk about any of that.
Sure. On the the strike density and proliferation sort of issue, I think this is a decade-year-old problem, probably with the introduction of weeklies, but with 10% of the volume, now at 55+% of the volume, we couldn't deny that weeklies were popular. They were essentially enabling a different use case and behavior that otherwise, couldn't have been done with a standard contract or, in terms of the monthly series. Something we talked about as an industry today is that, there's essentially a slot of 800, soon to be 850 opportunities for products to have weeklies. And, we're using around 75% of that capacity for the market. And so one of the things NASDAQ looks at, one is, do we have the right strikes in the market? And so we see a lot of concentration in the first 2 weeks of a weekly cycle. So there's up to 5 weeks. And so the thing we chose to do, based on a data-driven exercise, was how do we essentially eliminate waste in the market, which was essentially contributing to quotes, contributing to storage costs and upkeep for the market, which had no impact or limited impact in sort of a usability. And so that was an area that we thought was low-hanging fruit. We accommodated this in a manner that was deemed responsible. We dropped about 15% of weekly strikes in terms of every Thursday we're pumping out 40,000 strikes, and now that number is south of 35,000. So it's a nice win. It's low-hanging fruit. It's a start. And so we said, what are the problems that still need to be addressed? We're at 1.6 million series, but we added 1,500 names. And with that, we want to say, where do we want to have product in the market? Where do we think there's still opportunity for us to modify and adjust? And so one of the things we looked at, we said, we have these Monday and Wednesday products. We see that there's a lot of concentration of volume in the front 10 days of activity. But this came along for the ride, if you will, of saying it gets a third and a fourth and a fifth Monday and Wednesday. So how do we modify that? Do we still need them? Let's talk about it. And then you look at other ETFs which don't have them. And so CME has options on those ETFs, options on those commodity products. So that's your golds, your silvers, your oils, your nat gases. and treasuries. And so, like, as an industry, kudos to the ETF issuers that have really built, great campaigns, great products that investors want to use. And so how do we take some of the sort of the success from SPY, IWM, and QQQ with Mondays and Wednesdays and redeploy our capacity into where people want to trade?
And, Ovi, to you guys, in terms of some of the new proposals, some of the new products, what it means for listing them on the platforms, education, et cetera.
Yeah, we obviously support new products, but we got to consider time and place, right? Like when you look at the chart behind me, we have volume. Right? Now I think we need to normalize and ensure that we're not adding, right, too much complexity. Knowing that, we just talked about how many new clients are coming to our industry, to our firms, and I think we need to spend some time normalizing this volume. Right, keeping it as consistent and right, easy to understand. Right, they're going through the educational process. Yes, it's easy to add new product, but is that the most responsible thing to do for the industry and for these clients? Right. So, I'm not saying we shouldn't add it. I'm just saying, is it the right time to continue to pile on new product, especially if the product has risk, adds complexity to the trade screens, right? And in addition to like all of the work, like. Example, in order to make this happen, a lot of firms need to spend a lot of their tech resources ensuring that, right, that the systems are up, available, and are able to provide that consistent experience. And then from a client side, when is too much, right? And I agree with Greg, and I understand, why you say that. And I think I agree with all of that. Like, there is opportunities to grow volume further. I just think we need to slow it down and do it at the right time and ensure that clients are able, if it's going to add risk, we need to be able to control for the risk. If it's going to change the way that they understand how the market works, then we need to take time to educate them so they understand. The last thing that we want is new product to come out and volume spikes and people blow up. We're in arbitration, and then the story is I'm never going back to the option market. Right? Wall Street always wins. We lose. That's not going to get us anywhere. So what we're talking about is just being responsible with the amount of clients that we're bringing in, and what we're doing with the volume and how we apply it to product, and just having a thoughtful strategy around when is the right time and place to add, whether it's complexity, product, or risk, and being able to have the tools to manage that. So.
Greg, what feels?
Yeah, the only thing I'll add, I think, always spot on. We need to be responsible when we roll out these new products. It's a partnership between us, the exchanges, and the customer, and to do it responsibly. So, from a firm standpoint, can we support it? What changes need to be made? Those technology resources, are they free to make any adjustments that might be needed? But more importantly, just making sure that, back to the customer, the risk, involved with them getting themselves blown up because they don't quite understand it. We need to have the proper support, education, and everything in place as well. And so, as new products come out, notification to us, the retail firms and others, that these are coming out, and we work, and the exchanges, do a great job of bringing that up. But it truly is a partnership between all of us, and it doesn't work if that partnership doesn't work.
All right, I think one of the side effects of the success that we've had over the last few years comes that everybody starts to look at what you're doing, and with that, we've seen the regulatory environment probably increase a little bit more, at least some inquiries. So, Ovi, I'm going to start with you in terms of, there was a recent inquiry about how complex options are handled. So I don't know if you want to talk about that at all. I don't know that my legal or compliance team are in the audience, but if they were, you already thanked them.
I already thanked them. But they would also tell me to probably stay away from this question, given that there is open inquiries.
Okay.
But I will.
That a boy, Ovi.
However.
So yeah, that's one. Obviously, that's one proposal. There's around 14 of them that are out there. Obviously, the regulatory agenda is very aggressive right now. At a time when we're also trying to sustain this above us, those volumes in our system. So there's a lot. And then add on that there's a few large firms that are also in the middle of integrations. And then let's add in a pandemic. Let's add in work from home. Let's add in T+1. Right? There's a lot of work on the same resources across the board. So The other side, I would say, the other point I would make, I think, is more around, I said it's fast and furious, right, the regulatory agenda. But in some regards, if the rule has really been out there for 20 years and we haven't looked at it, I don't see anything wrong with going back to, reevaluate our current, position and the way that the industry is operating. So I welcome it. I actually, in some regards, I think it's a lot and it's too fast, but I also applaud them for doing the hard work, right? And wanting to make, things better. But in wanting to make things better, I think we need to make sure that it's data-driven and that we do no harm, right? As long as we could do that, we can go review everything. Let's data-driven, do no harm, let's review it. But, my first point, let's take it one step at a time. And we can't review everything this year, right? So,
Greg Stevens, anything you want to add?
No, I mean, I think, Ovi said it pretty well. I mean, it's an aggressive agenda. I mean, we're out there, to help the customer. And if there's changes that need to be made, based upon that, based upon some careful analysis of the rules, that have been placed for a while, then yeah, I agree. I mean, I welcome, the discussion in a timely manner.
All right. One of the things, and I'll start with Greg Ferrari, it seems like this question is teed up for you, so to speak, more. Jonathan Kellner was nice enough to come to our SIFMA Options Committee today, and obviously we're going to have a new options exchange if all goes to plan with approvals, et cetera. And so, the easy question, I guess, is are there too many exchanges? But I guess the question I'll add a little bit more is, part that, but how, as you get more entrants, what does it mean for you guys, and how do you sort of set yourself apart with your different exchanges in this type of environment with more competitors entering?
I only have 10 minutes left? Jeez. Okay.
You're going to call your marketing team?
So, when we think about the business, we're operating essentially 9 markets, between our 6 option markets, our 3 U.S. equity markets. We run a Canadian market. We run the TRF, and that's just the U.S. And so we also run, obviously many markets in the Nordics. And so essentially the underpinning of that technology and capital allocation drives that investment throughout the world. And so we, as Nasdaq, run a fairly large market technology infrastructure business, and our technology is deployed in 130 countries. And so we can't just say this one competitor in this one sleeve and say how did that impact, potentially how we think about the business, because we're a global operator, right? We service, essentially tens of thousands of clients. And when it comes to the options market, those that, utilize our services directly understand sort of the underpinnings, the network topology, the architecture, all the fine-tuning that we do to compete. And, obviously it takes a village, right? And so we want to do no harm. We want to stay out of the way when it comes to servicing the end customer and the end user. But all this innovation and product is on the backs of sort of years and years of investment. And so I can't say that it's this number or that number, or where's the breaking point. But we do recognize when there's value created to the market, there's sort of law of diminishing returns at some point. The fact that we were able to grow 2 of our smaller exchanges up to a healthy level, that is an indicative sort of metric to say that people actually saw value in that, and we want to be able to, show that, sort of extend that beyond, where we are. MEMX coming in to be determined on the date. We hear Q4, heard Q3 today, heard Q1 next year. So at the end of the day, when they do come to market, it will be competitive just like always, and we welcome another exchange operator to the family.
Okay, thank you. Ovi, I'm going to ask you a question that's not as hard as the last one, but something I know that's near and dear to your heart a little bit, and that is around consolidators, because I think there's sometimes a belief that, a consolidator just signs up, comes in, and you alluded to it a bit earlier, and it's all great. So could you just talk about some of the work that you do and how you have to think about it as, from an order routing perspective, and, all the processes that you go to even bring somebody on board?
Yeah, I mean, there seems to be this thought, right, this perception that you just connect and you let it all flow, right? You just point it in the right direction and you let it all happen. Reality is that these firms that are competing, these liquidity providers are competing. I just don't know that there's a more competitive market out there today. It's cutthroat. At our firm, we actually provide our liquidity providers a report card every single day. So they're competing every single day. They know how they did against their competitors every single day. And we used to do it, monthly. We used to do it quarterly, monthly. You continue to accelerate we'll call it the turns, because it only accelerates competition, right? If I told you only once a month, right, how you were doing, you would only pivot or make adjustments once a month. So we went to weekly, and now we're at daily. And there's daily adjustments that need to continue to happen. And we, right, route like all based on execution quality, like 100% execution quality. We do consider their service, their scores, but it's a very competitive market, and I applaud them for the work that they do and the amount of capital that they need to apply just to create this very consistent, robust experience that, is allowing us to have these types of numbers. And, there is going to be new entrances. I mean, it's been said that, it's very concentrated and there's not enough competition. But if you were to take a step back for a minute and you said, well, what's the right number? 50, 20, 100? It doesn't matter where you start. This competitive process will start to weed them all out. And there's always going to be winners. There's going to be winners and losers. And there's people that can compete with this firm or can't compete with that firm. They will exit because of the competitiveness. So the fact that there is not a lot of them today, right, that have meaningful market share is really a reflection of how competitive it is. If it was easy, everybody would show up. Everybody would be there. But it doesn't matter where you start. If you want to reset and let's start at 100, we're going to work ourselves back down to, right, a handful, maybe a dozen or less, liquidity providers, just because of the cutthroat competition and the amount of investment and capital that are required to compete on a daily basis is not something that everyone's going to be able to do at the same level.
Thank you. And that was great. So Greg Stevens, with news coming up of stock splits. And I think it's something that, many of us on the retail side have kind of been wanting for a long period of time. So what does it mean for your clients? What are you hearing from people? Any concerns?
Less on the concerns, more on the opportunity. I mean, most of these large value, high-priced stocks, from the Googles or the Alphabets and the Amazons of the world, most of our small retail investors, don't have the opportunity to really participate in that, whether it's the stock or the options. And just, they get priced out of. So, it's been refreshing to see, them, take a step back and, start to, issue those stock splits and look towards the future. And I think for us, mostly it's communication, with our customers, making sure that they're aware of how this is going to affect their account, what they're going to get in return, for those. From an operations standpoint, it all has to go seamless because as we know, there's a lot of concentration in trading, within these, within these underlying securities, and there's going to be a lot of eyes on it. And so, we have a checklist. We go through it multiple times. We'll do some dry runs and make sure that it all happens. But I think it's tremendous. I think there's definitely a lot of goodness for the retail investor, coming out of this.
And Greg Ferrari, since it's your team that I know, thank you to the team for working on this. Anything you guys wanted to add?
Yeah, so we have a chief economist who's been at this for a long time now, which is to say, high-priced stocks are really really in the underlying, not in the options, have essentially a sort of a wider spread or essentially a non-optimal sort of trading range in terms of the quoted bid-ask spread in the equity. And so we think that's optimized between $40 and $100. We actually did a 3-for-1 split, when we were, in our last earnings call, just to fall into that range. We're going to, follow our own advice of our economist. And so the fact that these are the largest names in the index and have such a sort of a large investor demand and appetite to democratize access through the cash should essentially enable more options volume, right? As we obviously grow, that will potentially change over time, but we definitely see a short-term boost coming for us. and it's really a healthy market indicator that more people can be able to access these products.
All right, awesome. We got less than 2 minutes. If anybody has a question, we're happy to take it. Everyone's like, no, let us go drink. All right, with all that, thank you all very much. Great job by these guys. Thank you.
My man, great job.
Work, bud.
Thank you. Great, guys. That was great.
Thank you. Thank you so much, gentlemen. Appreciate it. Thank you. Thank you so much.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.